indicators of what could be a crisis, and what happened in 2008 was not a demand deposit question, which is here in M1. Right? See, demand deposits didn't do anything pre-2008, although they have been huge infusions of cash from all the stimulus in our crazy days, our 2020 crazy days. But here we have the two very liquid, very hot money supplies, which is repurchase agreements and institutional money market funds, which is like a stable coin, basically. Old school stable coin. These guys go in and out of treasuries all the time. And as you see, massive bets. So what they do is they take their treasuries. I'm talking about like hedge funds. They take their treasuries. They use them as collateral, borrow against them, and make riskier bets. Try to make money on the spread. And that transaction is called either a repurchase agreement or a money market fund. Different terms, different type instruments. And they're trying to make more money, make more interest than the treasury yield itself. But as you see, this was a huge pop in 2008. Right? It popped. The top was here, March already. And as the bubble started to burst, by the fall, it was already coming down. But notice the ramp up here. Very big. Notice the ramp up here. You can kind of say, okay, on a linear chart, it always ramps up. Right? So you look at that back to 87, which was actually a crash. Yeah, you can say it always ramps up and it's risky, and I get all that. By the way, we'll put the Fed repo here. All right, so this is the Fed, by offering repurchase agreements itself to the market. They kind of let this number 7, let's even take off number 3. They let number 7 not go crazy. Right? Number 7 just kind of stays relatively stable. No inflation, no monetary inflation is going into the economy as the Fed becomes the counterparty and says, look, we'll repo with you. Don't go into the market. And of course, on the other side, the hedge funds are like, great, you're a safer party than anybody else. I'll repo with you. Then the Fed says, well, that distorts the market. Let's stop doing that. So they destroy money. They destroy sort of base money, as you would call it, even though this is for non-banks. And then that base money, you can see it very clearly, goes right back into the economy. So it's very inflationary when the Fed lets this go back into the economy. And that's what's happening. So it is kind of reminiscent. Again, I'm not saying it's going to be a crisis tomorrow, next week, next month. I have no idea. But it's a bit risky right now, at least in the U.S. money markets.